Hey everyone, it's Julie here with Tip Ranks. Today, we're taking a look at two stocks from the Nasdaq 100 that have been underperforming year to date, but Wall Street still rates them a strong buy. So let's get into it. All right, guys, welcome back. Thank you all so much for being here. Yesterday, the Nasdaq 100 hit new all-time highs due to a surge in tech stocks and a shift towards a risk-on market sentiment. This is due to some easing geopolitical tensions and some positive commentary from the Federal Reserve. That got me looking at the Nasdaq index. While some of these big tech names were making notable gains, others have been left behind. From the Tip Ranks homepage, we headed on over to the Nasdaq index, and then on the left here went over to the holdings. Here you can search by a couple ways. I went for the biggest losers year to date, and we found a few stocks that, though they are in the red, analysts rate a strong buy. So despite lagging behind so far in 2025, it seems that Wall Street analysts anticipate a comeback. So today we're going to take a look at these companies, what it is that they do, and exactly what Wall Street analysts are predicting for the stock's future. Just before we get into these stocks, I wanted to let you guys know that Tip Ranks is having their half-year sale. This is the biggest sale of the year, where you can unlock 50% off from Tip Ranks Premium and Ultimate subscriptions. So if you've been wanting to unlock some fantastic research tools, now is the time to do so. Head on over to the Tip Ranks website or follow the links in the description down below. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. Now let's jump right into these two strong buy NASDAQ stocks. First up, we're taking a look at Atlassian. They trade under the ticker TEAM or TEAM, currently priced at $197 per share. They are in the green over this past year, but year to date, the stock is down 18.5%, and from highs back in February, they're down 38%. Atlassian is a global software company that specializes in creating collaboration and productivity tools for software development, project management, and team workflows. Headquartered in Australia, their products are designed to foster teamwork across industries, serving over 300,000 customers, including major companies like NASA, Netflix, and Tesla. They operate on a subscription-based model with a focus on cloud-based solutions and have recently integrated AI capabilities to enhance their offerings. Their freemium model and self-service sales approach allow scalable growth, targeting teams in tech, marketing, HR, and more. Of course, there are reasons behind the stock's decline year to date, including macroeconomic uncertainty, some management changes, and a few things from their last earnings report, such as slowing revenue growth. They did come out with record revenue of $1.35 billion, and that did grow 14% year over year. However, that growth rate did represent a significant deceleration from the 30% growth rate the prior year. And when we look at their net loss for the quarter, that was $70.8 million, and that was compared with net income of $12.8 million the year before. They also saw a slowdown in their cloud revenue growth, and their future outlook was a bit below expectations. But there are silver linings to this earnings report to look at as well. While that cloud revenue did slow down, it still grew by 25% year over year, contributing significantly to their total revenue. And they achieved a free cash flow margin of 47% and had over 1.5 million monthly active users of AI across their platform, showing significant interest in their Rovo AI capabilities. Taking a look at how Wall Street weighs in, a 5-star analyst from Morgan Stanley recently reiterated the TEAM stock as a top pick. They said Atlassian is recognized as a best athlete in the software sector, a designation that reflects its ability to innovate rapidly, maintain a strong market position, and execute financial targets effectively. Furthermore, the current valuation of Atlassian's stock presents an attractive entry point for long-term investors with the potential for margin expansion and multiple growth levers to drive future success. With 21 current analyst ratings, the stock does come in as a strong buy, based on 16 buys and 5 holds. And the average price target of $265 implies an upside potential of over 33%. Looking at those recent ratings down below, all double-digit upside potential, ranging from a hold with 13% upside to a buy rating with a 61% upside. And for our second underperforming NASDAQ stock, we're taking a look at the trade desk. They trade under the ticker TTD, currently priced at $69.55. Overall, in the past year, they have lost 26%, and year-to-date are down 40%, falling from highs back in February. The Trade Desk is a global technology company specializing in programmatic advertising, offering a self-service, cloud-based demand-side platform that enables advertisers and agencies to plan, manage, optimize, and measure data-driven digital advertising campaigns. They operate in the U.S. and internationally, serving advertisers, agencies, and other service providers, and their platform supports various ad formats and channels, including video, display, audio, native, and social ads across all devices. You may have noticed on their stock chart that big decline in February. That was from their Q4 earnings report. They did have a miss and provided some weak Q1 guidance. Their CEO said that the miss was attributed to small execution missteps, including internal restructuring and personnel changes that disrupted performance. They said that while they're proud of some of the accomplishments, they are disappointed that they fell short of their own expectations in the fourth quarter. That quarterly report led to a strong sell-off, with the stock dropping over 30% following. But more recently, near the start of May, they came out with their Q1 earnings report, and following that, we saw an 18% jump as the company did report some solid revenue growth. Revenue grew 25% year over year to $616 million. Their CEO said they were encouraged by the early impact of the strategic upgrades at the company that they implemented in Q4, contributing to this outperformance. Also in the quarter, the company saw significant CTV growth, which continues to be their largest and fastest growing advertising channel, and that around 2/3 of their clients are now using their new platform, Kokai, which includes some AI integration. Following that earnings report, we did have some analysts increasing their price targets, including ones at Truist and Wedbush. The Wedbush analyst noted the strong Q1 results and healthy Q2 guidance, with management attributing the top and bottom line performance to the rising adoption of Kokai. The analyst at Truist is more bullish on the stock after their strong Q1 print, and more recently, just yesterday, we had another analyst from Citi reiterate their buy rating. They said that despite the competitive headlines, particularly concerning Amazon's DSP, they believe that competition is not as direct as it seems, leaving ample growth opportunities for Trade Desk. The macroeconomic environment for CTV advertising appears healthier than anticipated, which bodes well for the company. With 23 buy ratings, 4 holds, and even 1 sell, the Trade Desk stock does come in as an overall strong buy, with the average price target of $87 implying an upside potential of over 25%. Looking at those price targets down below, the most recent ones here range from price targets with an upside of 12% all the way up to 65%. So that is a quick look at 2 tech stocks in the Nasdaq 100 that have been underperforming year to date, but still come in with that strong buy consensus from Wall Street. Let me know your thoughts on these 2 companies and whether you think they're going to turn things around this year. I always love hearing from you guys. Of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you always do your own research and due diligence. Thank you guys so much for watching. Have a wonderful day. I'll see you back here next time.